White Claws in the middle of the shoot. You're gonna be looking at one sloppy captain when this is all over.
2 hours later.
Where are my pants?
I'm a little bit country.
Damn it, Captain.
And I'm a little bit rock and roll.
What's up, CrewTube? Welcome back to Captain's Coffers. I'm Captain Inc, and with me as always is Cliff Barr Jones, and today we'll be talking about taxes. Yes, we finally got to a topic about finances on a channel that is all about financial wellness, but today we are definitely going to take a huge dive in. But as we go through, you're going to see and understand why it was so important to get into mindset and habits, because when you have your right mindset and habits, all of this is going to end up becoming easier to you later on for conquering. Unfortunately, we're not going to be able to hit everything in taxes today. It is just way too vast. If you ever tried to read the tax code, well, that thing is massive, and it is the driest literature out there. So for the sake of trying to keep things a little bit lively, really teaching you something that you're going to enjoy, we're gonna walk past it.
Let's go!
So today we're gonna focus on personal income tax. We're gonna try and help you reduce whatever your tax exposure is and definitely get that liability down. All this adds up to more money going back in your pockets. Nowadays, a lot of people don't know how taxes work, and that's understandable. I once had a mentor reach out to me and he told me, you know, once you get out of grad school and you got your tax degree, for the first 5 years, you don't know anything. For your second 5 years, you kind of know some stuff. That third 5 years, you know a lot. And then finally, you have everything mastered. You're good, you know it. And that is just in time for them to go and change the entire tax code, and now you know nothing all over again, and it starts all over. This actually brings me to one of my favorite jokes about tax season. I love when I hear people say, I'm so happy that school prepared me for parallelograms because parallelogram season is right around the corner. Well, guess what? Parallelograms do not change. They are exactly the same. They are the same now that they will be in 100 years. The tax code is not changed. It is ever evolving. It is always changing for the needs of what is going on in the now. So because the needs are constantly changing for the government, for us as people, the tax code will always change to reflect what those needs are. So, tax is a compulsory contribution to state and federal revenue levied by the government on workers' income and business profits. So basically what this means is every dollar that is generated by someone, whether it is through a W-2 worker or it's the business's bottom line, the government has their hand in it and they're getting a little piece. What we want to do here, helping you to master your taxes, making all that money come back to you, is generally the best way to really go about winning the day. There have been several people out there that have said the best way to win income is to win at taxes. Pop quiz, would you rather have to pay $1 in tax or $1 million in tax? Go. Trick question. The idea is you want to make enough income where you would normally owe $1 million in tax, but you're able to reduce your tax exposure that you only have to pay $1 in tax. So how do we do that? Well, there's two main ways to reduce your overall taxes. Number one, reduce your income. Which, let's be honest, that is not an option. Number two is to maximize your deductions and tax credits. Well, what are those? Let's dig a little deeper. A tax deduction is a direct reduction of your total taxable income. So, what is taxable income? Income is really just any dollar you generate. So whether that is through a W-2, maybe you have your own business, a side hustle that you're making some money, maybe you have some investments that are making money, maybe even grandma is just handing you a couple of bucks. Every dollar that comes to you is supposed to be reported and can be used to determine what your taxable income is. Now, this starts off as something known as gross income. That is the total amount in there. After we look at our deductions, we're gonna get down to adjusted gross income. And then after that, we have more deductions, which will get us to our total taxable income. We're gonna get into all of that. So like I said, the tax deduction is that direct reduction that is going to drop your total gross income down to this adjusted gross income. So what are things that go ahead and actually contribute to this? Well, there are several different things that can go into it. Some performing arts expenses, certain retirement plans, books and school supplies that are paid for by the teachers, Army Reserve expenses, jury duty pay if it went to your boss instead of going directly to you, moving expenses for anyone in the armed forces, certain medical expenses, things like HSAs. Those are health savings accounts. We'll get into those eventually. Student loan interest. And if you are self-employed, there's something known as the self-employment tax. Half of that is a deduction for what is known as above the line. So these above the line deductions are used to help reduce your total gross to an adjusted gross income. After this, there is still one more major deduction to come from, and you can do that in one of two ways. This is either the standard deduction or itemized deduction. So when it comes to the standard deduction or the itemized deduction, you can take one or the other. You cannot have both. So what's the difference? The standard deduction is a flat dollar amount based on marital status, or if you're single and have children, which makes you the head of household. The children must be your kids legally, so adoption does count. But for those animal lovers out there that have little fur babies, yeah, those don't count. I know they're cute and I know we love them, but it actually is written into the tax code under subsection 152 that it needs to be a legal human being. So because of this, fur babies out, real kids are in. Itemized deductions are eligible expenses that can be claimed instead of the standard deduction. So what do we use to determine if we are going to itemize or if we're going to take the standard? Well, the first thing that we look at for itemized deductions is medical expenses. Now, the actual definition for what we need is a little bit vast, so I'm going to leave that right here for you. But generally, the idea behind it is you want to collect all of your medical expenses throughout the year. So this is things like medical insurance, co-pays on doctor visits, prescription drugs. All of these things will end up adding up to help determine what your total medical expenses are. If they are higher than 10% of your adjusted gross income right here, that will be included as an itemized deduction to potentially help you reduce your tax exposure. Next is state and local taxes, which is also known as the SALT tax. This will maximize at $10,000. The inclusion is property tax, and you can either use state income tax or state sales tax. So it's one or the other, property plus state income or property plus state sales tax. The point behind this is never assume one versus the other. Your state income tax might be lower than what you paid in sales tax throughout the year. It differs from state to state, so keep those receipts because you may be throwing away extra money come tax time. The following is mortgage loan interest. Now, mortgages will come later in this series. We are going to get into them. It's very important to discuss them. But the general thing is that most mortgages will have interest. In fact, I'm pretty sure 0 of them don't have some kind of interest. Any interest you pay on your mortgage loan is going to end up adding into your itemized deductions to maximize the itemized deductions. Charitable contributions are a very well-known deduction to be taken on itemized deduction. Everyone always ends up giving something to charity, whether that's through goodwill or you're giving a little bit to your church. A lot of people give to charity each year and try not to miss out on this. This can be taken as a deduction anywhere generally between 30% to 60% of your adjusted gross income. There are a lot of different loopholes when it comes to this. So since it is very intricate, it's something that we can address later on. If you have any questions about it, again, drop them in the comments section. I'll be more than happy to answer them for you. You can always choose between itemized and standard, but do yourself a favor here. Take whichever is bigger. And don't assume it's going to be one way versus the other. Do the extra work, build the habits, get the mindset. This is your money. So the government actually put an amendment into the Constitution to make sure that they can put taxes on you, because if you forgot, we used to throw tea in the harbor about taxes. So yeah, that was a thing, and now we have this to worry about. So keep track of your stuff so this way you can conquer your taxes. So we have your total income. We took out some above the line deductions. Then we looked at your standard and itemized deductions. This brings us to your total taxable income. From here, what we do is